Welcome back. We're at the low point of the day and we're at a very, very crucial juncture. 18,020, 18,030. You don't want this level to break decisively because then, in fact, you get into a bit of a tricky zone. Remember, positioning for the expiry is such that you're counting on the 18,020 odd level holding out. So let's see whether or not the bulls throw in the towel or there is some support that comes in at these levels. But getting to our next management then, PNB Housing Finance. It posted a mixed set of numbers in the past quarter. The assets under management, they continue to decline and now down for the 12th straight quarter. But there has been a sharp rise in the margins to around 4.7%. And the asset quality as well did improve this time around. That explains why the stock is doing a relative outperformance. It's up close to around 0.5%. But to understand the way ahead, we are joined by Mr. Girish Kauski, the MD and CEO at the company. Hi, sir. Good morning. Thanks so much for joining in. Well, disbursements were quite good, right, for the past quarter. But that's not translated into AUM growth. Could you tell us why is the rundown so high? And also give us a guidance on the AUM growth for the next couple of years. That's for FY23 as well as for FY24. Go ahead.
Good morning, Nigel. I think if you look at the book growth, there has been book growth in last quarter. I think if you see on a YOY, we've grown by 7%. So last quarter, I had indicated that this year we will close book growth with close to 10%, maybe 9 or 10%. So there is book growth, and we have seen good traction, on disbursements in last 2 months. And if we talk about next year, in terms of disbursement, we will be able to grow at about 22 to 25%. And in terms of book growth, it will be about 17%. So I think the trend should continue for next few years, as I had mentioned in the last time. And if you look at on the collections, I think a lot of work has happened, and therefore you will see that GNP has come down, at the company level, both on retail, and also to a certain extent on corporate. And if you talk about book retention, it has been a very good story. It has been a very good story that we were able to retain customers in last quarter.
Mr. Kauski, hi, good morning. Could you talk to us a little bit about cost of funds? Because across banks, that is the story which is playing out. I mean, we just had the management of SBI cards, of course, very different business as compared to yours. But how do you see the progression of cost of funds from here for you? Where is it standard, and how is that likely to impact margins for you?
So today, if you look at cost of fund at a portfolio level, it's about 7.55%. I think incrementally it is slightly higher, and we know that the interest rate cycle has almost nearing its peak. So having said that, I think in the entire banking system, there is a bit of concern on liquidity. So I think that pressure would always be there. But I think from PNB housing point of view, we are very, very clear in terms of margins, and we will try to moderate yield depending on cost of funds and the margin. So I think this is something which was there in the past, which is there now, which will also continue in future, whether it is an interest rate rising scenario or interest rate falling scenario.
What does that mean in terms of specific numbers, though, Mr. Kauski? If you can leave us with some sense of what the numbers would look like
in terms
margins?
Of? Okay, so I think as a long-term steady-state business, I had mentioned about 3.2 as NIM and 2.2 as spread. Of course, today, if you look at NIM is more than 4.5% and the spread is about 3.8. So, maybe if you look at the next few quarters, it might be in that range. But I think on a long-term basis, because we are into housing, I think for a company like PNB Housing, a NIM of over 3% and spread of about, let's say, 2.2, 2.5 should be ideal. I know today we are on the higher side, but yes, we want to operate at these levels going forward. Of course, if you have an opportunity, always it will be higher. But on a long state, I think this is what is the guidance.
Okay, well, that's very strong. The disbursal growth that you spoke about, 22 to 25% for FY24. I wanted to understand a little bit in the different segments that you operate, whether it's salaried, self-employed, corporates. Where are you seeing maximum amount of growth potential? And if you can just break it up for us, because in the quarter gone by, your salaried segment rose almost 14%. Can you tell us a little more?
I think that is more by design, Sonia, because we want to increase the profile mix towards salaried, which is because that is, I think that portfolio behaves very well vis-a-vis compared to self-employed. And in terms of product, we want to be highly skewed towards home vis-a-vis compared to non-home. So it is more by design. We've just started this journey. Going forward, we want to see salaried segment increasing to up to, let's say, 65 to 68%, and the rest by ACP and ACNP. In terms of product, our focus is going to be on home loan, which will be, I think, ideal is about 70%, and probably 30% could be non-home.
Okay, got that. But despite a very strong disbursal growth and very aggressive targets, your AUM growth is not happening. That's something that's been lagging a bit. Why is that? And what would the AUM growth target be for the full year FY24?
If you look at the entire retail and corporate, corporate we are degrowing because we are not doing incremental business, and it is a degrowing book. And the focus is now on retail. Now retail constitutes 92% of the entire portfolio. As I had mentioned, corporate, we want to work on recoveries, bring down delinquency to a reasonable level before we could restart. We will restart, but it might take about, let's say now about 5 to 7 quarters. Right. So till that time, corporate book is degrowing, and therefore you will see that at a overall enterprise level, the book growth is at 7%. If you look at last quarter, it was negative, but this quarter it is flat. If I have to compare it sequentially, on a YOY we have grown by 7%, right? So this is on book. So this year we will close, book growth close to 10%, and from next year it will be about 17%. Largely, the story is going to be on retail because now we are focusing on prime. We have kick-started affordable vertical, in last week of December. So we will see some traction in Q4 of this year. And next year, I think it will be a great story to add to our growth trajectory.
All right, Mr. Koski, affordable housing is another segment that you're focusing quite a lot on. How much does it contribute, say, to your disbursals as of now? And where do you see this contribution headed?
So I think probably 1 year from now, we are looking at incremental 25% to come in from affordable vertical.
And what is it currently at?
We just started now. It's hardly about 2 weeks. So we just started. We'll see traction, from coming quarter onwards.
Okay, all right. Mr. Koski, thanks a lot for joining in and giving us a perspective. So that's a 20 to 25% disbursal growth that they're looking at for FY24. But let's move on. Sona BLW Precision Forgings posted a strong set of Q3 earnings. The revenue, EBITDA, profits have all come in at the highest ever level. Another positive, the company's order book has increased to 23,800 crores with 2 new electric vehicle program wins in the third quarter. Vivek Vikram Singh, the MD and Group CEO of Sona BLW, joins us now to talk about that. Vivek, thanks a lot for joining in. First, I want to understand more about the EV opportunity because there are a slew of new EV launches taking place in the Indian market as well. Globally, too, traction has picked up. Can you just quantify for us what exactly is the opportunity for you this year and how much would it add to your order book?
Sure. So about 25% of our total revenue comes from battery electric vehicles. Most of it comes from global markets, US, followed by Europe and then India. India is still a smaller market as far as EV is concerned in terms of volumes. But the opportunity size is fairly decent. At the bottom of the pyramid with EV two-wheeler and three-wheeler, as well as on the top with electric buses. So we're trying to focus on all of it. Opportunity size is fairly large. 73% of our order book is from EV. So that's booked orders where we have purchase orders in hand. So if you look at that, 24,000 crores and then do 70%, that's the size of the opportunity.
Okay. All right. Hi, Vivek. Good to speak to you. The street clearly likes your numbers, but execution is going to be key from here on. Now, you reported your highest ever quarterly number of around 675 crores. How do you see things shaping up? Order book is good as well, as you say. So for FY24, what kind of a revenue growth, that is execution, you're looking at? And also, what kind of a margin band are you looking at as this, the shift gradually moves towards EVs? 25% is likely to move higher from here on. Go ahead.
Yes. So, neat jacket, by the way. And yeah, we are always...
Thanks for that, man.
Execution is key, man, for everything you do. We used to do 10 crore quarterly profit 7 years back. We are at 100 this time. It's 10x growth in 7 years. So execution is always key. We don't give future guidance for short term, but yeah, 25 to 30% is every year we've grown for the last, I don't know how many years, and that's what we'll continue. Yes, EV should increase. We've released our sustainability report this time, and we've taken a 45% of revenue from EV by FY26 as our target. So that we are fairly certain of getting to.
Okay, I think it's also because, you know, this 25% margins that you're sitting at, it is perhaps the highest that we've seen in the industry and highest across industries perhaps. So do you think it's peak, or is there scope to increase it further? Because a lot of your peers have also told us that, you know, as the kit value goes up with the EV players, as technology-based products increase, there could be some more value add and more addition to your operational performance. Is there scope to increase it further beyond 25?
So the EBITDA margins are actually 27, and we've remained between 25 to 27 for the last 22 years of our existence. So that is our normal, and 27% EBITDA and 15% PAT is what we expect to do, given the current product mix and geography mix for the foreseeable future. We intend to stay in that range. Can it go up? I mean, yeah, if alloy steel prices cool, maybe it can go up, but that is something I don't have enough knowledge on. So base steel, as you guys must know, has already cooled. However, alloy steel has not come down because of nickel, moly, and chromium and all of those other elements. So we are waiting for that to happen. Inflation cooling should give us that advantage, but I won't like to overpromise and underdeliver. So let's stay at 27 and 15, which is what we have delivered for 20 years.
No, but can we flip it around then? Vivek, you know, I track the steel space pretty closely, and price increases suddenly have come about. And we're seeing some restocking that's taking place as well. The China reopening factor is a bit of a risk. Is there a risk to these margins? Or at least, you know, y'all are calculating it at around 27%. I think you're including the other income. We are calculated around 25, 26%. So from current levels, is there a downside risk, or can you hold on to these margins at least?
I don't see much downside risk, to be honest. In the last 8 years I've been in this company, steel's already at one of the highest it's been. Second, we're not taking other income. Actually, that's the Forex. But for a 72% export company, Forex is income for us. We do get paid in dollars.
Got that. Now, Vivek, just a quick point on how is competition in the EV component space shaping up? Because, I mean, you know, you would have a great sense of that overall. It's a profitable space. It's a growth space for the next many years, decades, actually. So that also attracts a lot of competition, increase in investments. Could you give us a sense?
So that's a very good question, and I like how you framed it. Actually, the competition kind of restarted. Everything got reset around 2016, 2017 when the electric powertrain came about. So the legacy people's advantages went away, and even people like us who were newer could do new things. We compete with the global majors who were legacy in this field and now obviously are competing. But like, I'll give you an example. The EDL we've done, that's the first time an EDL has been designed for a battery electric vehicle. So EDLs were done for ICE, but it's a electronically locking differential. It was never done for EV. So we are able to compete on an equal footing with global tier 0.5, as you can call them, Bosch.
Sorry, Vivek, what is EDL? Sorry, if you could just...
Electronically locking differential. So we used to do differential assembly. Now this is an electronic version of it, which is...
All right.
So we are now able to do things for the first time, which is a very big thing for an Indian company. Because see, Indian automotive industry started 60, 70 years after the American industry, 30, 40 years after Japanese. So we were always at a disadvantage. EV has reset it. I think anybody who invests a lot in R&D and tries to compete on product can have a great opportunity. And I think a lot of Indian companies can have that opportunity.
No, but to bring that slightly broader top-down question to, you know, impact on your company's prospects? Is intensity going up? Are you having to compete harder with on pricing, etc., or not really?
I don't want to sound arrogant, but when you're at the top, the competition comes at the bottom of the queue. So that is not what actually should stress you out. See, auto industry in general, the top 4-5 guys would have about 50 to 60% of the share of any product. Then there'll be 10, 15 people who'll have the next 20, 30, and then there'll be many in the bottom 10. So let's say somebody starts making differential products today, right? We already make 1.2 million a year. To get there will take 3-4 years. So the people joining at the bottom is not what worries us. It is the old legacy guys in driveline. Are they waking up to us and trying to put more in R&D? Second, yeah, there could be people in Taiwan, Israel, San Francisco, disruptive startups who can do new things. That's where we try to watch more.
Sure. So, Vivek, just one final question from my end. Are you seeing any slowdown in the clients that you cater to in the European Union and China region? I ask because that's been under pressure for a while, but now the narrative is that things are improving in China. But what is the situation on the ground?
So, Sonia, you answered your question actually. There were 5 quarters of negative growth in Europe, light vehicle sales. This Q4 was the first one when there was an uptick. So I think things have bottomed out in Europe. China, I won't comment. It's still uncertain. The COVID thing and things shut down, and it's a little hazy there.
Very quickly, Vivek, have you heard from Blackstone? That's a bit of an overhang on the stock. They still have close to 20% stake in the company. Any word from them? Do they want to hold on, or are they looking to sell out?
Look, they're financial investors, so eventually they will sell out like all other financial investors do. That's the job they have, they invest to make money. But I don't think there is any hurry, and I doubt anything is there in the recent, near future.
Okay, got it. All right, Vivek, you're sounding pretty confident about the business going ahead. Explains why your stock is up close to around 4% while the markets are at the low point of the day. It's been good chatting with you. Well, Mitesh Thakkar is back with us. Mitesh, it's looking a little scary now, actually. On an expiry day, when you're down more than 100 points and you're breaking some crucial support levels, how do you think things pan out from here? We are at around that 18,000 odd mark, which is a very, very important level.
So, Nigel, I think we've kind of had a breakout failure yesterday. So that would typically mean that there would be some pressure given the fact that 18,180, 200 did not sustain. In the worst case scenario, I think a retest of 17,800 could happen. So I think, we are back in that range, and now we might head towards the lower end of the range. I think 18,000 was some kind of a pivot. If we start getting an hourly or a 2-hourly candle closing below that level, good chance that 17,800 could be tested. So I think we are possibly going back to the lower end of the range.
All right. Individual stocks? Yeah.
I have a sell on Divi's Lab that's breaking down. So keep a stop at about 33.35 and a target of around 32.40 can be looked at on the downside. And one buy as well. Coal India, I think, had a good breakout last week, now giving a pullback. So good levels to enter here with a stop at about 221.5 for targets of 235.
Okay, Mitesh, thanks a lot for that. Let's do one thing. Let's take a quick break. On the other side, Manisha Gupta will join in for an update on the commodity space. Stay with us. Okay, we're all celebrating Republic Day in full spirit here. We have Manisha Gupta now with us in the studio. Manisha, looking all pretty. What are you going to talk about?
Well, pink of health and pink in markets as well. You take a look at the aluminum prices. Every metal turn by turn really seems to be running up. And aluminum has been a bit of a laggard in the last couple of weeks, but we have seen those prices gain up as well. So trading at an 8-month highs, and after yesterday's a percentage point of gain, we've started almost quarter to 0.5% on the higher side for this one as well. The strength comes in on the back of various factors. So until now, we've seen 12% of gains in aluminum prices in January 2023 itself. All-time high for aluminum was $4,100 per ton. That was in March 2022. And aluminum prices have had a very jagged history since then. At these current levels, the markets are trading at around $2,600 to $2,700 a ton. So the markets do believe that from here on, aluminum has a lot of higher side to go in the coming weeks or months there. The dollar index trading at around below 102 is something that clearly has been supportive. China reopening has been supportive as well. And the fact that you have seen lower production coming in from major producers has been yet another reason. So we have seen power rationing continuing in China and Europe, and that has led to lower production. When you look at the Europe aluminum production, that has declined by nearly 12.5% in the previous year, and the street expects the number to continue to be in the negative in this year as well. So whether it is about Dunkirk plant, where the production has declined by 20%, or it has been about Slovakia, where the Seoul smelter has closed all its primary options. And then we also have seen Montenegro plants continue to be in the weaker side as well. So nearly 30 to 60% of a cut in various capacities, whether it has been about smelters or production in mines, has been shut in Europe and China, and that has been what has been bothering. Alcoa has said that it will start its Spain plant, but only after switching to renewable energy. So what the street also is getting very excited about now is green aluminum, and a lot of work and investments are happening into that. The other thing that is quite supportive for the prices is the overall production itself. In 2021, we saw global aluminum output gain up by 2.7%. That number has declined to 2% in 2022. And the markets believe that in 2023 as well, it is going to be about 2%. Demand expected to be on the positive side. So aluminum could go all the way to all-time highs yet again. Is something that the banks and brokerages really seem to be putting out.
All right, Manisha, thanks very much for that. That's commodities in focus right now. We'll take a very quick break here. The market's down 100. All right, I think we'll hold on and not take that break, but we'll go across to Mangalam. Pidilite is in focus. The stock is reacting to those numbers, not in a good way. Mangalam, take us through the numbers.
It is a weak set of numbers coming in for Pidilite. You know, for 2 quarters in a row now, the company has found itself in a bit of a sticky situation. Earlier, it was raw material inflation, and now it is lack of demand. In fact, the overall revenue of the company came in at around 3,000 crores, just shy of 3,000 crores. The street was working with a number well above that. 3,150 was the CNBC-TV18 poll. EBITDA shy of 500 crores mark. We were working with a number of 580 odd crores, and the net profit as a result of which was also below expectations. Remember, the company's EBITDA margins at 16.5%, much below their always stated target of 20 to 24% band for the margins. 1% volume growth in their consumer business is also below street expectations of 3 to 4% growth. And gross margins, while they've shown a slight improvement quarter on quarter, they're still the same level as what we saw in the first quarter of this financial year. The management has attributed this weakness in the performance to high inventory built up last year, same time, because of imminent price hikes going forward. And gross margins, while they've improved marginally, they haven't improved as much, primarily because of the high cost inventory that they were sitting on. Demand conditions in both rural and semi-urban have been weak, and they are increasingly optimistic of the future, primarily on account of the weakness that we're seeing in raw material inflation now. So to that extent, management commentary on the way forward will be extremely crucial, given the stock has corrected about 20% from its highs.
All right, thanks a lot for that. Nazara Tech is the other one on our radar. Reema, tell us why.
Well, it's a strong set of earnings coming in from Nazara Tech. So revenue growth at 20% on a quarter-on-quarter basis, up 70% on a year-on-year basis. In fact, the revenue momentum for Nazara Technology has been strong over the last couple of quarters. Margins are down on a year-on-year basis, but they have improved on a quarter-on-quarter basis. The reason for the margin decline on a year-on-year basis is because now that things have opened up, the company is spending a lot on events, like on-ground events, content costs have gone up. So that's the reason why EBITDA margins at 9.6% is lower than the 16.3% margins that we had a year ago, but there is an improvement on a quarter-on-quarter basis. The key driver for growth for Kidopia for Nazara Tech is the gamify learning, which is that Kidopia app that they have for children, the younger children, the toddlers age group. And that had many sluggish quarters due to the change in the Apple privacy policies, etc. But things now appear to have turned around. The base also for the Kidopia business has improved. So which is why Kidopia revenues of 70% on a year-on-year basis, coupled with the price hike that the company took, has driven growth for Nazara Tech this time. Back to you.
Okay, thanks a lot for that. Kidopia, something that I've used for a very long time, and glad to be out of that phase. Let's slip into a quick break. On the other side, in our special edition of What the World Wants from Budget 2023, Lata will connect with Brian Jacobson of Allspring Global Investments. Stay tuned.